markets are deflating. We've given back most of 2024's gains, if I measure it based on the financials that I follow. We've gone to somewhat of a defensive posture. I was just setting up a new portfolio, and first thing I did was the long gold, short dollar trade, which I think most people have figured out by now. And, unfortunately, the Trump administration is attacking some obvious issues, but in a very disruptive way. So while it's perfectly fine to talk about the role of the dollar and the cost of running the dollar as a utility for the rest of the world, how you do it's very important. And the disruptive effect of volatility of Donald Trump is very expensive. It's tens of trillions of dollars. The banks did okay this quarter. They made a lot of money trading, not so much on banking. But the ones I'm really worried about, frankly, are my mortgage lenders because of the volatility this quarter. I think hedging is going to be a mess. So, mortgage rates are up. Most of the indicia you would use to measure how consumers and voters feel about all this are probably not where you would like to see them. But, Trump has told us to be patient. So we have to just see what happens. I think the markets are in a defensive posture. That's how I would describe it. I would say the increase in volatility since January when the president took office, probably half of it's attributable to him and his administration. Let's do a little context here. Last year was an extraordinary year for many financial instruments. They went up a lot.
Right.
The banks were up 50% in the 12 months in 2024. We've since given that back. Because of the extraordinary period we've been in since COVID, the actions by the Fed, the fiscal actions, everything else, there's been a lot of money in the street, as you know, and it's caused financials to go up and down. It's caused tech stocks, everything else. So along comes Donald Trump with his 19th century economic perspectives. And basically, this has taken the air out of the balloon. And it did it in a way that was not anticipated. It was a surprise. And we surprised markets, surprised investors. That runs the risk of being what we call systemic. So Trump isn't quite a systemic event yet. We're still, up year over year, barely. But he could take a lot more air out of the balloon before he's done. So, as I said at the start of our conversation, long gold, short dollars, right? Look, gold has been repressed for the past 100 years. That's what Franklin Delano Roosevelt did. He seized the gold, devalued the dollar, and fixed the price at a silly level with his friend Jesse Jones. At the end of the day, the whole Bretton Woods agreement after World War II, all of this was anti-gold. It said you will use paper. The paper will be the dollar, and we will have all these institutions to make this work. Because everybody had left the gold standard by then, right? They had to. But here we are, and it looks like gold is coming back because our dear friends in Washington who don't recognize any limits on their actions and don't like paying taxes, by the way. They don't like levying taxes. And then again, that's nothing new here. But what it's done, it's run full course. And people can do the math. They can look at the U.S. budget deficit, and they can see that we are going to have to hyperinflate. And what I mean by that is that eventually the debt will become so onerous that we will reverse the logic of Abraham Lincoln and we will turn the debt into currency. That's what the greenback was initially. It was a piece of debt that bore interest. It wasn't currency at all. Nobody thought of it as currency. But Lincoln said, well, you must use it. So the ability of the U.S. to enforce that kind of authoritarian rule is very limited today. We have Bitcoin, we have all these things going on, which are all a reaction to this repression of value, if you will, the repression of gold. I think regardless of whether we get the Trump trade discussion finished this year, and I think we will largely, gold is still going to be a good trade. It's a very good trade, medium to long term, simply because there's so little of it above ground that's deliverable. The supplies of gold that you can actually buy today for spot delivery next month are limited. And I think that it's a short squeeze here as far as the eye can see, because the Russians and the Chinese aren't going to sell. Think about it. We go back to a bilateral world where people tend to hold the currencies of their major trading partners. And then they have some gold, they have some dollars, maybe the yen and the euro. We're figuring this more. Those are the three big currencies that you can actually use for global trade. The rest of them are too small. So unless you want to be big and take the inflationary consequences of running a big currency, then, the dollar is going to continue to predominate for the time being. Even with horrible fiscal problems, all of the rest, right? They'll still use it as a means of exchange. They just won't stay there very long. Any significant commodity is a store of value. Piles of copper. They do go up and down in price, but I don't think anyone questions the long-term value of commodities like that. More commodities than cryptocurrencies or even real estate. We're at the end of a very long cycle in real estate that unfortunately got tangled up with monetary policy during COVID. So I did a biography of Stan Middleman last year. Stan's the founder of Freedom Mortgage, one of the smartest guys I know. And, we're still expecting a pretty significant housing reset in 2027-28. The script goes like this. Fed eventually cuts interest rates for obvious reasons. When is kind of immaterial. You'll get a little bump. You'll see home prices go up again, a little rally in terms of lending. And then after that, we see a correction because we've run out of buyers. When prices go up too much, you run out of buyers. And that's where the U.S. is now. Home prices have gone up way too fast. You see spec homes all over the country, by the way, especially in the Southeast, in the Southwest. Expensive stuff, well above the average $400,000 price. And it's not moving. They're turning the rentals. So there has been some speculative building, mostly at the top of the market, though, not the bottom. The bottom is still very tight. What I've been telling my readers is that I think the trade kerfluffle will be more or less settled this year with countries that we didn't really have a problem with in the first place. Most of the European countries, Japan, a lot of the Asian countries, Australia, even Vietnam, you're going to find that there's a tug of war between China and the U.S. Because the more nations kind of deal with us, the more the Chinese are going to be isolated. They're already seeing the wreckage from the Belt and Road fiasco, where they took advantage of all these small countries in Africa and Latin America. None of those deals have worked out well because the countries can't pay. So, I think this is a fundamental shift in the U.S.-China relationship, and the other countries are being dragged along simply because Trump, he doesn't want to raise revenue, but I hope he's not going to invest it in Bitcoin, for God's sake. There's a credibility issue if you do things that are too wacky. It's okay being conservative. It's okay, doing what they're doing in my space and housing, trying to get things under control. But Trump has got some big problems he'll have to deal with. So getting trade and their budget done this year is a big issue for them because they need to move on to some other things. They have a very long agenda. So my sense is most of the friendly nation trade deals will be done this year. Just follow the Japanese. They're all going to line up. Well, I'm already starting to selectively go shopping. I love going shopping when there's blood on the street. It depends on your risk tolerance. I have been fairly blunt with my crowd in terms of trading points in the portfolio. In fact, I'm working on a piece right now. So I'm telling people to keep their powder dry, do your homework for stuff you couldn't buy last year because it was too expensive, right? What would you like to buy now? I bought a little American Express last week, and I'm going to probably buy more lower down. I think all the financials are going to give more ground. But, that stock was ridiculously expensive. It was silly. It was over 7 times book. Jamie Dimon is just below 2. So Jamie's not cheap right now. A lot of these banks are giving ground, but the exemplars in all of the sectors I follow are going to do fine. The wind will be at our back next year and in 27 because of the Fed. But there's only so much the Fed can do when you have the big fiscal problem on the one hand, and then you have this huge overhang in housing that still needs to be fixed. We cannot rebalance this market really since COVID and the extraordinary measures they took then and restore some semblance of affordability to single family homes without having a reset. We're going to need to see 15, 20, maybe more than 20% price declines before we can get enough people back into this market so it's going to perform normally. It's going to be quite a shock because remember, a lot of companies have been changing their business models over the last couple of years as the Fed started tightening in order to accommodate that. And now, if we get an ease, even if it's only on the short end of the yield curve, that's also going to throw a big monkey wrench. Think about the prepayments on mortgages if rates actually fell. The margin calls on some of those assets are going to be extraordinary. What we see coming forward is volatility for a lot of different reasons. And you're going to have a strong constitution, as Felix was saying, and focus on your medium-term objective. Because there are some days when you make a decision to go buy something that you're going to regret the next day. Misery on the eights. It generally comes about every 10 years. COVID obviously was crazy. We refinanced 2/3 of all mortgages in the United States in 18 months. And now the industry is at a famine. They're not making any loans at all. So it's still volatility with a capital V. I don't care what industry you're in, but you're dealing with rates of change that make it very difficult to have any kind of a plan. That's what it comes down to. If you want to say what's the cost of Trump, what's the cost of some of the other factors we're dealing with the Fed, that's really it, is volatility. What you're seeing in the market today is that the focus on income, on safety, is absolutely at a high. So on the one hand, you see common stocks, whether it's tech, I don't care what it is, they're all giving back ground. But if you look at the same names and their income producing securities, preferred and debt, they're being bought up left and right because people want yield all of a sudden. I'll give you a great example. I own a huge chunk of a grandfathered TRUPS issued by Citigroup, but it's a 9 3/4 coupon. At one point, this is a $25 preferred, right? It was trading in the 30s at one point, which tells you, the yield was much lower, right? But now it's given up a little ground, but not much. It was $29 this morning. So there's still investors out paying up for that security just to have that coupon flow. And all of the preferreds are like that. They've given up a little ground depending on the name. JP, no, definitely not. People are hiding there. In fact, JP grew deposits 4% this quarter when the whole industry only grew 2%. That tells you how people like to go hide in the fortress balance sheet. Well, it's fear of missing out. It's FOMO everywhere. Almost every question in finance can be explained with FOMO. And the reason is that eating is a fundamentally hardwired human emotion. It's where greed comes from. But when we see other people having dinner, but we're not, well, then we're going to take action to join the party. We chase the shiny object. We're all really just a bunch of smallmouth bass at the end of the day. I think it is primarily because of the age of the population. The baby boomers are more cautious. Great example, a lot of boomers who have high costs, say they live in a state like New York, what are they doing? They're selling their homes outright sale. They're not going into another purchase. And you see this all over the country. Outright sales by most of the big mortgage lenders I work at are, more than half. It used to be 10%. So what that tells you is that the cost of home ownership is forcing some people out, and others are just making a decision to relocate, usually to a cheaper state. So they're migrating, obviously. But my point is that that's a big change. That doesn't talk to me about a healthy market, not at all. Insurance costs have gone up so much that the balances that are held in servicing portfolios have now affected the price. So those escrows that sit there for 12 months before the insurance is paid out are now twice as valuable as they were 5 years ago.